name is Drew Edwards with International Tax Advisors with another episode of Tax Briefs. Previously, we have discussed two layers of tax. That is one layer of tax at the corporate entity level and another layer of tax on the individual when those dividends are received from the corporation. Essentially, this same $100 of revenue is subject to tax twice. The government has obviously seen that this is a detriment to certain individuals that don't need to operate in the corporate form, but still need a business to carry out their operations. Should they still be subject to two layers of tax? And there are several entities which are not subject to a separate layer of tax. And that is why we think about entity choice when trying to solve the two layers of tax problem. One such entity is an LLC. Generally, if an LLC is owned 100% by a single member, meaning it's a single member LLC, for tax purposes, it will be disregarded. And so what do we mean here? We mean that this entity does not have a regarded tax presence like a corporation does. Both provide you legal liability, so this entity could be sued and this entity could be sued separate, but for tax purposes, this entity is not subject to taxation. So when $100 is earned, it flows all the way up to the individual and it's taxed at the individual level. We talked about the highest rate previously being 37%. Since this is not a dividend, there would be no qualified dividend treatment. And so this individual pays $37. Now, the $37 on one layer of tax is generally equal to the $36.8 that we have in a corporate structure. There may be reasons that you need the corporation, but at the end of the day, it's helpful to know that the type of entity you choose can completely impact your tax consequences. In a later video, we'll talk about how some of these tax entity classifications can be chosen or elected.